Let's get in Peter McGuire to speak about his thoughts on what this means. He's the Chief Executive Officer at XM.com. Peter, good morning. Thanks for joining in. This is bad, yes. Is it even possible to predict how worse can it get?
Well, good morning, Niraj. I think that's the $64 million question. We haven't seen numbers like this since 1991, and I remember that distinctly. When that Desert Storm, I've never seen markets fall as heavily or as I suppose violently in a matter of days as what we're seeing now. US dollar index at 95.2. Everything's just smashed to the downside, and crude's taking it well and truly, showing what that you've got the Saudi issues and you've got what Russia's playing. So there's probably further downside yet. It'll bounce, but that just gives traders an indication that the market hasn't hit bottom yet.
Yeah, that's my question, really, Peter. Is it possible to predict? Maybe not down to the exact dollar, but would you reckon that even after this plunge, the next few days' trajectory is lower from where we are right now?
I think it'll probably hedge. You've got the rest of the day to go. I mean, we're waiting for Middle East to wake up. You guys are just starting your breakfast show in Mumbai. You've got the Middle East, which is going to be fascinating once it hits the UAE and then Saudi, and then roll it across to Russia, and then you've got the Euro Day, UK, and then we hit, the big boys tonight in the US. So I think there's further, it'll be softer as the day wears on, and it could bounce, but you've got the Dow down. I'm seeing that down 1230. It's an enormous number when you're thinking about what can happen over the next matter of hours. So it's going to be violent trading, Niraj, and these are unheralded times. So I think it's hard to pull a number, but NYMEX crude's running at $30.08 at the moment, down 27%. I think there's further softness yet.
Stay on with us, Peter. Geoffrey Dennis, independent emerging market commentator, is also joining us right now on the phone line from California. Geoffrey, thanks very much for taking out the time.
Thank you.
Let's talk a little bit more about the implications that this is going to have on overall global sentiment. I mean, people are talking about crude oil prices that could probably slump to levels that we'd seen during the financial crisis. And if that happens, it's not good news for equity markets across the globe. And how does this pan out for U.S.? Because U.S. grade and other, grade oil prices have already come up by 35%.
Yes, well, the drop in oil prices is a direct hit, of course, for the U.S. economy now because of all the increase in output in the U.S. economy, and it will lead to a drop in investment in the oil sector, which is going to be a further hit to activity levels in the U.S. economy. But generally, I think the way you have to look at the oil price decline is it's a little bit reflective of what I think is developing here, which is almost certainly a global recession on the back of the disruption to activity from the coronavirus. But I think it's a development with a difference, and that is that this plunge in oil prices, which appears to be by far the major factor triggering these huge losses in Asia so far today, and also the drop in the futures in the U.S. This is both a supply and a demand problem. Demand is sliding because of the global economy, and the supply side is, of course, as everybody knows, OPEC couldn't get a deal, couldn't get Russia to agree to cut output. So I think it's probably overshooting the oil price, that is, and it's entirely possible you'll get some sort of new attempt by OPEC to stabilize output over the weeks ahead, especially if we plunge towards yet lower lows. But I still believe equities have got further to fall because I just don't think you've seen all the bad news yet about the global economy by any means at all.
We had the Fed cutting rates by 50 basis points. And now, with the yields dropping below 1, in fact, now at 0.5, there is still that section of the market that believes on March 18, when the Fed meets again, the probability of another cut is much higher this time. Do you think that they have that much ammunition to go ahead and tackle this issue now that the yields have come down to about 0.5%?
Well, I think they do, clearly, because in some sense, in certain parts of the curve is inverted now. And I think what the truly dramatic drop in bond yields is giving you is a green light for the Fed to move rates again. So I think it's just a matter of how much they move in the meeting next week, not this coming week, but the week after. I would prefer to see the Fed not using a lot of ammunition here by, say, cutting by 75 basis points, which is what I've heard some commentary on. I think it's more likely perhaps the Fed moves by 25 or maybe by another 50. because I was critical of the Fed moving when it did early last week, because I think you need to leave some ammunition later for when you really do slide into recession. And so I don't want the market to drag the Fed too low. But no doubt at all, it would be a bitter disappointment for the market, I think, if they didn't cut rates next week. I just think it'll probably be a fairly modest cut. And yet at the end of the day, in this extraordinary environment here of the impact on activity of the coronavirus, it's not actually remotely clear why lower rates will help. It'll help sentiment, it'll help the mortgage market, it'll help refinancing activity, but it isn't going to really allow people who don't want to go to the cinema or restaurants because they're worried about the virus. They're not going to react to a lower interest rate. So it's not clear it's the right measure anyway, but I think the market is dragging the Fed to reducing rates again. I just hope they don't cut them too far.
Okay, we'll get to Peter, but in just a moment too. But Jeff, just one question. Last Monday when you were with us, you mentioned, and I'm glad, I hope people took notice of that investors should try and play by the recession playbook. My question is this. Emerging markets would be net beneficiaries in the slightly medium term of falling crude prices, and this looks like it's here to stay. Would you continue playing by that playbook, and therefore would you believe that equities by and large have still some more room to go? Whether developed or emerging is another question.
I think there's no question equity markets have got further to fall. I'm assuming peak to trough, the U.S. market is going to go down at least 20%. Now, it may go down a lot tomorrow. As of Friday night's close, it was down about 12.5%. 20% is a reasonable recession sort of move in equity markets. I don't think this is anything like as serious as the 2008 global financial crisis. Hopefully it's not anyway. We'll see about that. And I don't think things were as overboard as they were during the tech bubble in 2000. So I don't think you need to see those huge declines you had then. But if this is a recession, I think markets do go lower, and I still think it's way too early to start thinking about buying. Now, what's helping EM here? A few things helping EM here. Number one is China is doing better in terms of the market. And, of course, as you know, the speed of the pace of the new cases of the virus in China has slowed right down. That at the margin is probably helping EM. What's helping EM as well is the dollar's quite weak now. It's gone from 109, 110 against the euro to 113, 114. That will help emerging. And lower oil prices, as you say, at the margin are a benefit for a number of emerging markets. But at the end of the day, if you get a global recession and equities come down, it is very hard for emerging markets to outperform. Because typically, you know, what investors do is they pull away from risk and they go towards safe havens. So I don't think EM is going to outperform here, but I think we're getting a little bit of help from one or two factors. But my main message here is we're going down again further. I think on the equity side, at least another 7 to 10% in the US. And I think EM is going down as well.
Jeff, thanks very much for joining us this morning. Really appreciate you taking out the time.
Thank you.
Peter, one last question to you as well. Saudi Arabia has got capacity of producing 12 million barrels a day. They said that they're going to ramp up productions to about 10.5 million barrels right now. Do you expect any retaliatory measure from Russia as well? And if they do take it up to max capacity, how much lower can the prices of crude oil go?
Gee, I mean, there's so many different moving parts there. We've got a relationship naturally that has been built over the matter of probably many, many years, Russia and Saudi. Is this the start of something far more perverse, that there is a relationship breakdown between the two parties? That's only just sheer speculation, but there'd be a number of traders, no doubt, taking that into consideration. MBS, what's happening in Saudi? You've got that issue that they had last Friday as far as the royal family and treason. So it just seems to be many different parts are playing out here. Saudi's got the firepower to certainly push prices a lot lower. They're the elephant in the room. And let's just see whether, what Russia's prepared to do. They might, toe the line. It all plays very favourably also in some ways for US. So the consumer wins, and that's going to be a big benefit, I think, over the next matter of months if prices stay down at these sort of $35 to $40 levels, it's going to be a win-win to not worry about the demand destruction so much, but from a consumer standpoint, more dollars as far as spending power.
Right, got that. These are very uncertain times indeed. Peter, thanks very much for joining us this morning.